In business and investment decisions today, it's important to look beyond just returns and focus on balancing those returns with the risks involved. Risk-adjusted return strategies help us evaluate investments by considering both the potential gains and the risks, which leads to better resource allocation, protects capital, and supports sustainable growth. Some common ways to measure this balance include the Sharpe ratio, Sortino ratio, and Treynor ratio, which assess returns relative to volatility or downside risk. These tools are useful in many areas like managing investment portfolios, corporate finance, and strategic planning. For example, when a company decides between two projects, one with steady returns and another with higher but riskier returns, risk-adjusted analysis helps pick the option that adds the most value without taking on too much risk. Similarly, asset managers use these metrics to benchmark performance and ensure that the risks taken match the company's tolerance. When companies enter new markets, they also evaluate risks like political or regulatory issues alongside expected returns. This approach helps avoid putting too much exposure in uncertain environments, ultimately supporting smarter and more resilient business strategies. The image shows a professional using digital tools, highlighting how these strategies often rely on technology and data analysis to make informed decisions that enhance shareholder value. To calculate the required risk-adjusted rate of return, one common approach is the Capital Asset Pricing Model, or CAP, which takes into account the risk-free rate, the investment's beta, and the expected market return. For example, if the risk-free rate is 3%, the beta is 1.2, and the expected market return is 8%, the required return would be 3% plus 1.2 times the difference between 8% and 3%, coming to 9%. This means the investment should generate at least a 9% return to justify its risk. Another method is the Sharpe ratio, which measures the portfolio's return above the risk-free rate relative to its volatility. If a portfolio returns 12%, with a risk-free rate of 3% and a standard deviation of 10%, the Sharpe ratio is 0.9. This indicates the portfolio earns 0.9 units of excess return for each unit of risk taken, which is decent but below the threshold of 1.0 typically considered strong performance. Both methods help investors understand if the returns adequately compensate for the risks involved. The Sharpe ratio helps us understand how much return we're getting for the risk taken, with values above 1 generally seen as good, above 2 very good, and above 3 excellent. Values below 1 suggest the return may not be worth the risk and might need a second look. The Sortino ratio refines this by focusing on downside risk, offering a clearer picture when we're concerned about negative returns. A Sortino ratio of 1.5, for example, means the portfolio earns 1.5 units of excess return for each unit of downside risk, which is considered good. Scores over 2 indicate excellent risk-adjusted performance, while values below 0 mean the portfolio isn't compensating for risk at all. To see these concepts in action, J.P. Morgan uses CAP and Sharpe ratios to adjust their portfolios, especially during volatile markets, by favoring assets with lower beta, preserving strong returns relative to risk. Similarly, Tesla applied a risk-adjusted approach when expanding its gigafactories, carefully weighing political, supply chain, and currency risks and managing them through partnerships and local sourcing. This shows how risk-adjusted thinking applies not only to finance but to complex business strategies as well. Using risk-adjusted return strategies offers several advantages, including better decision-making by aligning investments with the investor's risk tolerance, preserving capital by reducing exposure to extreme losses, providing standardized benchmarks for performance evaluation, and boosting investor confidence through disciplined risk management. However, there are also challenges, such as the complexity of requiring advanced modeling and accurate data, subjectivity in risk estimates due to varying assumptions, the potential for over-conservatism that might cause missed opportunities, and the dynamic nature of risk factors that can change rapidly. Each method plays a specific role. CAPM is useful before investing to estimate the required rate of return based on market risk, helping to assess if an asset is fairly priced. The Sharpe ratio compares overall portfolio performance by factoring in both upside and downside volatility, making it a good general indicator of risk-adjusted returns, and the Sortino ratio focuses on downside risk, which is particularly helpful for risk-averse investors concerned with minimizing losses. In short, CAPM serves as a pricing and return benchmark, Sharpe measures general risk-adjusted performance, and Sortino targets downside risk. These frameworks are key for businesses aiming for sustainable growth amid uncertainty, as they help optimize returns while managing risk. Success depends on accurate risk assessment and the ability to adapt, especially when volatility is common, making it essential to balance risk and reward thoughtfully.